There are several ratios that investors and financial analysts use to evaluate a company's financial performance and health. Here are some commonly used ratios along with examples. Price to earnings ratio. This ratio measures a company's share price relative to its earnings per share, EPS. It helps investors determine if a company is overvalued or undervalued. For example, if a company's stock is trading at $50 per share and its EPS is $5, its P/E ratio would be 10. Price to sales ratio. This ratio compares a company's market capitalization to its revenue. It helps investors determine if a company's stock is trading at a fair value relative to its sales. For example, if a company has a market cap of $1 billion and its annual sales are $500 million, its P/S ratio would be 2. Debt to equity ratio. This ratio compares a company's total debt to its equity. It helps investors evaluate a company's financial leverage and risk. For example, if a company has $10 million in debt and $20 million in equity, its debt to equity ratio would be 0.5. Current ratio. This ratio measures a company's ability to pay its short-term debts using its current assets. For example, if a company has $2 million in current assets and $1 million in current liabilities, its current ratio would be 2. Return on equity, ROE. This ratio measures a company's profitability relative to its equity. It helps investors determine how efficiently a company is using its equity to generate profits. For example, if a company has $10 million in equity and generates $1 million in profits, its ROE would be 10%. Gross margin. This ratio measures a company's profitability by comparing its revenue to its cost of goods sold. For example, if a company generates $10 million in revenue and incurs $6 million in COGS, its gross margin would be 40%. These are just a few examples of the many ratios that investors and financial analysts use to evaluate a company's financial performance and health.